If you've been avoiding BDCs because you think high yield is too risky, ARCC has outperformed the S&P 500 over the past 12 months, the past 5 years, and since it went public more than 20 years ago, all while paying a juicy yield that currently sits at 8.8%. Not many investments can hang with the S&P 500 while delivering consistent income. Today, we'll look at why ARCC is my favorite BDC. I last reviewed ARCC in January 2023. Yikes. Back then, it was yielding more than 10%. Now it's yielding just under 9% because the price has increased since then, while the distributions have remained constant. At just over 20 years, ARCC has one of the longest distribution histories I've seen for a BDC. This 30-cent payout in 2004 has grown to 48 cents. That's a 60% increase in distributions. There was one cut back in June 2009 following the recession. It fell from 42 to 35 cents, then took almost 13 years to climb back to 42 cents and beyond. Apart from that negative, the rest has been consistent. These little bumps were special dividends. BDCs distribute these if they have an unusually profitable quarter. Interesting that these special dividends were paid in 2022, the worst year for the stock market of the past decade. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. The current yield of 8.8% is below the 12.8% average for BDCs tracked by Raymond James, but as you can probably guess, the highest yield isn't the best investment. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider. Link in the description, it's free. Ares Capital Corporation, ticker ARCC, is a business development company, or BDC. The yield is much higher than a typical dividend stock like, say, PepsiCo. The reason is that just like REITs, or real estate investment trusts, BDCs are structured as regulated investment companies. That means they're required to pay out at least 90% of their net investment income as dividends to investors. Their incentive to do that is that the RIC structure exempts them from paying corporate taxes on that income. So how do they make money? What does business development actually mean? I think of them as a hybrid between private equity, venture capital, and a bank. They typically lend to medium-sized businesses. Much like a bank, the BDC makes money from the interest they earn on the loans. Unlike a bank, though, BDCs also have the option, in some deals, of taking an ownership position in the borrower's business. Under that scenario, they're even more motivated to help the growth or development of the business they lend to. I said they pay out at least 90% for favorable tax treatment. The other 10-ish% they retain for themselves isn't going to allow them to grow much. So it's reasonable to assume that if you invest in a BDC, most of your returns will be in the form of those monthly or quarterly payments you receive rather than price appreciation. Another key difference between a BDC and a bank is their source of funds. Banks get their money from customer deposits, so banks rely on customers not withdrawing too much at any one time. In other words, a bank run. For this reason, banks rely on the government to regulate them so the public trusts them to hold their money. They may also rely on the government to bail them out if there's a big problem. BDCs don't take deposits. They borrow at a low rate and lend out at a higher rate. Here's a list of how ARCC sources its funds. Lots of different interest rates and different maturity dates. If we boil it down to the weighted average using this chart from ADS Analytics, they're borrowing at just below 5% and lending out at just over 11%. The difference between those two numbers is their revenue. Also worth noting that at 4.9%, ARCC is paying less to borrow money than the median cost across all BDCs tracked by ADS Analytics, which is 5.9%. Apart from the yield, here's what I like about ARCC. The total return charts I showed at the beginning of the episode are the most impressive thing about ARCC. It's not easy to beat the S&P 500 over 20 years and pay large dividends. ARCC is the biggest BDC and by a long way. Size is an advantage because it allows them to spread their risk across more than 500 borrowers. It also allows them access to capital at favorable rates, which explains the 4.9% I quoted a moment ago. ARCC is one of a handful of BDCs that are rated as investment grade. As of Q1 2025, ARCC has $1.29 per share of cash for a rainy day. This is known as spillover, undistributed taxable income, or the good kind of UTI. So even if their revenue falls short in the future, they can keep the 48-cent distribution going for quite a while. That number came from the last earnings report. If you want a breakdown of their earnings and what all the numbers mean, this analysis by ADS Analytics is excellent. It was one of the articles I read on Seeking Alpha to research this episode. If you're watching this before July 7th, 2025, Seeking Alpha just extended their summer sale by 3 days. I used the premium membership, and I'd be lost without it. The link in the description connects you to the current promotion or the Armchair income discount, whichever is greater. Non-accruals is a measure of loans that are at least 90 days past due. At 0.9%, ARCC is below the median of 1.2% for BDCs tracked by ADS Analytics. Here are the risks and concerns I have about ARCC. During a market panic, the price of BDCs like this one usually take a beating. The most extreme example was in 2009 when ARCC fell twice as much as the S&P 500. Although in defense of ARCC, it also bounced back and then left the S&P 500 in its wake. BDCs issue variable rate loans, so if the Fed cuts rates, ARCC will lower the rates it charges its customers, which will reduce the revenue. Eventually, lower rates will also mean that ARCC can borrow at a lower rate, but in the short term, lower rates means lower earnings. So that's a short-term problem. If anybody thinks lower interest rates are bad for BDCs, take a look back in history when interest rates were low, really low. In 2009 to 2016, interest rates were close to zero. Look at ARCC versus the S&P 500 during that period. It did just fine. This one applies to all BDCs. They pay ordinary income, so not as tax efficient as some other high-yield investments like preferred shares or MLPs. Some BDCs have outperformed ARCC. Here are a couple of examples: Main Street Capital and Hercules Capital. Main Street pays a lower yield of more like 5.5%, but has enjoyed more price appreciation. Hercules Capital pays a higher yield of 10.5%, but the price is far more volatile. So for Hercules, when you buy, does make a big difference. I own all three, but my largest allocation of those three is to ARCC because it's the mix of yield and total return that works for me, and compared to other BDCs, the volatility is low. Somebody who likes to actively trade their portfolio might be more drawn to Hercules Capital, for example. If you don't want to pick individual BDCs, you can buy a fund that specializes in them, like PBDC. Ares Capital is currently PBDC's third largest holding. That fund doesn't have as much history as ARCC. It's only been around since 2022, but since it was launched, it has actually outperformed ARCC. PBDC is actively managed by Mike Petro, and if you want to learn more about that fund, I'll link this interview with Mike in the description. Last week, ARCC was priced at 9% above its book value. Today, it's 11% above its book value, so it's not cheap. Over the past 5 years, it's traded below book value during the pandemic, during the 2022 bear market, and for a fleeting moment during the tariff chaos in April. So if you can wait a year or two for the next market correction, you can buy it at a discount to book. With income investing, you do get paid to wait, in this case, 8.8%. So unlike growth investing, it's not as important to buy at the absolute bottom. If I didn't own ARCC, I'd buy somewhere in between 1 and 1.1 times book because you don't have to wait long for that opportunity. And then I'd maybe buy more of it when it's priced below 1. I've held ARCC for years and I don't actually try to trade in and out of it. My current allocation is about 5%, which is my cap. I plan to hold it for long term unless they change their business model from what they've been doing for the past 20 years, which is unlikely. I've seen comments saying high interest rates are better for BDCs because they can generate more revenue, and others saying high interest rates are bad because they'll drive up defaults. It's not as simple as BDCs are good at interest rate X and bad at interest rate Y. As I explained in this video, there are lots of moving parts that drive BDC performance. Ideally, I like to hold the BDCs that have demonstrated a history of navigating all market cycles, high interest rates and low interest rates while continuing to pay consistent income. ARCC is a good example of that. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, click here for reviews that are focused on my top 10 holdings. That wraps it up for this look at ARCC. More Armchair Income coming soon.
Armchair Income.